Okay, so now let's look at turnover or efficiency ratios. Just checking to make sure that we're recording properly here. Okay, and first of all, what do we mean by turnover or efficiency ratios? A turnover ratio is going to be, let me just highlight it here for you. Okay. Some balance sheet term divided by some income statement or cash flow statement term. And an efficiency ratio is just 1 over that. In other words, some income statement or cash flow term in the numerator with some balance sheet term in the denominator. So these are aimed at measuring, for example, how much sales or earnings we can squeeze out of our assets, or how quickly we can convert assets into sales or cash flow, etc. Now we have a very important thing to think about that we haven't before. This is the first time we have looked at ratios with a flow term and a level term, or i.e. an income statement or a cash flow statement term. That would be a flow term in sales per quarter, sales per year, operating cash flow per quarter, operating cash flow per year are the units there. And compared to something on a balance sheet which has just the units of dollars, okay, assets in total assets in dollars, cash in dollars, or yuan, or whatever currency we are using. So because of that, we've got to be very careful to use consistent time units, okay? And what we're going to agree to do throughout is when we have turnover and efficiency ratios, we're going to use for our income statement or cash flow statement term, we're going to use sales per year, okay? So if we're looking at an annual ratio, just for example, we could use our asset efficiency ratio, which is sales over total assets. We're just going to take the total sales for the year and then divide by the assets at the beginning of the year. However, if we're looking at a quarterly ratio for the same thing, if we just take quarterly sales, what are the units of these quarterly sales? Sales per quarter. And we want to be able to compare everything apples to apples. So everywhere on our ratio analysis, we want the units to be sales per year. So how do we get from sales per quarter to sales per year? Well, we just multiply times 4 quarters per year. So then the units are going to be sales per year, and everything's going to work out perfectly. Okay. I'll keep bringing that up as we go along, so it's not confusing, hopefully. All right. The first ratio we looked at to introduce the concept of ratio analysis was our erstwhile asset efficiency ratio. And again, that was defined to be sales over in a period divided by assets at the beginning of the period, and for short called the AER ratio sometimes. So what's our intuition on this? Again, what's it telling us? It's telling us how much sales we were able to squeak out of each dollar of its assets that it had at the beginning of the period. Extremely, extremely helpful number. So we want to answer here, as always, the eternal question, is bigger better for this ratio? So let's see. I think if I can squeeze more sales from my assets, I'm doing better than if I'm not squeezing so many sales out of each dollar of my assets. So I'm going to say bigger is better. Okay. All right. And as with any other ratio, I've been skipping this a little bit. We can just go back to 8th grade algebra, put our intuition aside, and say, how could we therefore improve this ratio? We could increase our sales, or we could reduce our assets. How are we going to reduce our assets? We may have a factory that's very, very inefficient. We could close it, that type of thing. Okay. Our next ratio up, efficiency ratio, very, very similar to our asset efficiency ratio. It's our return on assets ratio. So instead of having sales in the numerator, we're going to have here, so I'm going to say NI instead of sales up here in the numerator. Okay, and we've still got in the denominator assets at the beginning of the period. So this is clearly answering for us how much net income we were able to squeeze out of each dollar of our assets. This is also going to be bigger is better. And again, we could improve this ratio by jettisoning some inefficient assets, as well as, of course, just trying to increase our net income. So there's a slight problem with this ratio, which is that our net income represents earnings to our equity holders, okay? So net income is only what goes to owners, okay? But remember, our assets are financed by paid-in capital and retained earnings, net income minus dividends, but also by our lenders, right? We could take out a $10 million loan and use that money to build a factory, okay? So in the numerator, we have something associated only with owners, and in the denominator, we have something associated with all the stakeholders, owners and lenders. So that's not really so consistent. So we could maybe do better. What if we had something like EBIT divided by assets? EBIT, remember, is earnings before interest and tax. So that would be earning. Another way to think about EBIT is it's earnings available to everyone, all the stakeholders, even the government, when we include tax in there before interest and tax. So EBIT over assets at beginning of period would be a better ratio. And why is it a better ratio? It's, let's say the ratio would be earnings to all divided by assets financed by all. So that would be more consistent. Okay. Nonetheless, return on assets is used fairly frequently, so I want to be sure to cover it with you all. Okay, better than return on assets. Arguably the most important of this class of ratios is return on equity, okay? Return on equity is defined to be, excuse me, let me delete that and underline this because it's very important. Defined to be net income in the period divided by equity at the beginning of the period. And I would just like to remind you that OE is equal to E equals equity. Okay. Again, 2, 3, 4, 5 different ways to represent everything in accounting. And so what's this measuring? This is measuring how much net income or profit was generated for, who's the equity represent? The entity's owners, okay? And here, as with all of our ratios, we're going to, when we're looking at quarterly, we're going to annualize, okay? So I didn't emphasize this as much with ROA, but it's true with all of these ratios, right? And the reason we want to do this is we always want our units to be, from our income statement or cash flow statement term, to be sales per year or net income per year or operating cash flow per year. So if we're doing a quarterly ratio, we always need to convert those units. Net income in a quarter, what are the units really of net income in a quarter? They're dollars per year, per quarter. And we need to convert those because we want to be consistent to dollars per year. So to go from dollars per quarter to dollars per year, we just multiply by 4, okay? And we're going to have this problem with all of these efficiency and turnover ratios, so we really need to remember that. Okay, ROE, also, like I said, it's very, very important. It's considered arguably the most important metric to managers and equity investors. Why is this unimportant to lenders? Because when we get to net income, we've already taken out interest, okay, and in the denominator, there is not any set of liabilities represented. We're only representing equity here. Okay, so 3 things that we want to have with ROE, okay? We want it to be, I haven't said this before, so I'll type it out. Clearly, we want it to be positive. Okay, and we want to answer the question, is bigger better? Yes, bigger is better. Big. And if we look over time, do we want ROE to be increasing over time? Yes, absolutely. So we want to say growing. Okay. And just FYI, little side point here, for most industries, ROE of 8% to 20% is very good. And if you have the most awesomely awesome of all companies and you have an ROE around 80%, which has happened sometimes, what's that going to do? It's going to draw in competitors. People are going to say, hey, if I get into that business, I can have an ROE of 80% instead of 20%, so let's do it. So it brings in competitors, and that drags everybody's ROE down. Unless you're a monopolist, and then the competitors can't come in. And that's a different situation that we'll talk about a little later. All right, so now I just want to make sure that we can compute these numbers. And I've got a little example here with Continental. And I want to look at Continental's Q1 ROE and its TTM ROE. And you can convince yourself, I have actual financial statement information for all 8 quarters and TTM for Continental here. At the end of this chapter, all of Continental's financial statements from which these ratios were computed are represented for all 8 quarters and aggregated into TTM, okay? So let's compute Continental's Q1 ROE. So let me just remind us of what that's going to be. This is going to be equal to 4 times the Q1 net income, okay, and that's going to, and remember, I'm multiplying by 4 because the Q1 net income, the units of that are sales, are net income per quarter, dollars per quarter, and I need to get to dollars per year. I want consistent units of dollars per year. So whenever I have a quarterly income statement number, I have to multiply it by 4. And then I divide by what was the equity at the beginning of the quarter, equity BOP. All right. So let's see if I did it right here. So I look at this. I have the net income for Q1 for the company here, and all right, that's going to be my numerator. And then I need, what's the equity at the beginning of the quarter? The equity at the beginning of the quarter is the end of period equity for Q2, right? Remember, every balance sheet is always done as of the end of the period. End of quarter 2 is same as beginning of quarter 1. So that's where I get that. So let's see if I should have minus 3 times 4 divided by 1,471. And I look over here, and that's exactly what I've got. So I'm pretty happy with that. Okay. And now for the TTM ROE, I need the net income from the past 4 quarters in the numerator, and you all should know by now, I can pick that up right here. And what are the units of this going to be? Net income per year, right? Net income of this quarter plus this quarter plus this quarter plus this quarter equals net income per year for the whole year, okay? And the denominator now, what's the beginning of the period for the year? It's the very end of Q5, right? So I'm going to need this number, right? Because this is the beginning of the year, all right? It's the end of the previous year. This is equity as of 12/31, end of the prior year, and that's the same as equity a nanosecond later at the very beginning of this year, okay? All right, so what do I have? Here I did this the dumb way. 126, as we know, is equal to 24, oops, where'd our typewriter tool go? 246 is equal to 241 plus minus 32 plus minus 80 plus or minus 3, right? So I could just pick that 126 up from the TTM, or I could add it up the slow way like I did here. All right, so these units here, net income, this is dollars per year, so that's what, I'm all good there. I don't have to multiply by 4. And we divide by 950, which is for the year, the beginning of period equity. And I work that out and I get 13.3%. So this slide is very, very important. So let's say, let's be very sure that you understand this slide and these calculations. And again, all of this is gone over in detail in the text. So if it's at all confusing, please read the text. Okay, so now there is the question. We know that we want ROE to be positive, big, and increasing. So now we want to go back to just thinking about algebra. How can we improve this ratio? We can increase the numerator or decrease the denominator, right? And all right. And why am I saying that? I'm saying that because for this ratio, bigger is better. Right? Okay, so in terms of finance, we would say increasing our net income is an operational strategy. So for Continental or Love, we would look at something called the load factor, which is just what proportion of seats on any given flight is filled. And so if we have a load factor of 80%, we would just try to sell out those existing 20% of empty seats. And that would be a great way to increase our net income. Pay a little bit more for fuel, but we'd get much more from the sales to the customers than we would pay in additional fuel. What in finance we would say is a financing strategy would be something like a leveraged buyout, which we saw an example of that with West End Advisors, where Partner 1 bought out Partner 2. And how did Partner 1 get the money to buy out Partner 2? He took out a loan. Okay, so you get the loan, you use the proceeds of the loan to buy out other owners, take their shares, and throw them in the 55-gallon drum and burn them. Okay, so we could also sell part of the firm. That would be called a spin-off. All right. Next ratio up is our fixed asset efficiency ratio, and that's defined to be sales in the period divided by net PPE at the beginning of the period. And this is very much like the asset efficiency ratio, right? This is saying, given the net PPE that you had at the beginning of the period, how much sales were you able to generate out of that net PPE? And this is good to know. We'd want to look at this vis-a-vis our comps to see if they're using their PPE more efficiently than us. In other words, are they squeezing more dollars of sales out of their PPE? And we also want to look at this historically for our company to say, is our use of our PPE getting more efficient, less efficient, or staying the same? If it's becoming more efficient, what does that mean? Bigger is better here. It's going to be growing, right? So let me put in bigger is better. We want to squeeze out as much sales as we can out of our PPE. Okay, and as always with all of these ratios, if we're looking at quarterly sales, what are we going to do with that sales per quarter number? We're going to multiply it by 4, and that changes its units to sales per year. So everything we're going to look at is consistently in terms of sales per year. Okay. Okay, so how do people talk about this? They'll say things like our fixed asset efficiency ratio is 2.7 times, or they'll just say it's 2.7, or they'll say it's 270%, that type of thing. other thing that's important to note here, and I haven't brought this up yet, there is not one universal set of ratios, which is great to use for every company in the world or every industry in the world. Excuse me. And this ratio illustrates that, I think, very nicely. Okay. So clearly for HCP, excuse me again, something like a REIT, and other industrial companies that are building things, okay, with the fixed asset ratio is going to be very important, but they're going to have a relatively small ratio because they have that big denominator. They have the net PPE, which they're going to have a lot of in the denominator. For something like JP Morgan Chase, West End Advisors, things like that, the fixed asset ratio is really not very important. JP Morgan Chase could choose to just rent all of its office space, okay? It could choose to rent all of its office equipment, its copiers, even lease all of its laptops and desktop computers and things like that. So JP Morgan Chase could be run with zero property, plant, and equipment. In any case, for all of these companies, because they don't have big buildings in which they're renting out space or factories producing widgets, their net PP is going to be relatively small compared to their sales and hopefully their net income. So a small denominator, a big numerator, they're going to have a big ratio, but it's an unimportant ratio, okay? So FAE is important for industrial companies, not so important for service companies. All right, so let me just write that down for us here, okay. And HCP is example of a service company for which FAE is important because it's got all those buildings that it rents out, even though it's not an industrial company. Okay, the next ratio up is our inventory efficiency ratio, and our inventory efficiency ratio is our COGS in the period divided by our inventory at the beginning of the period. So what's this telling us qualitatively? It's measuring how much of our inventory we match to our sales in the period or turnover per period. Clearly, bigger is going to be better in this case, right? We want to turn over or get rid of as much of our inventory as we can. Why? When we're getting rid of it, what does that mean? We're selling it, okay? So the units here, typically percent, folks say things like we turn over 20% of our inventory per year, or our inventory efficiency is 27%, meaning the same thing. Same issue when we're looking at COGS per quarter. We're going to multiply by 4 to change those units to COGS per year. Okay. Accounts receivable turnover, we will pick that up in just